Hey everybody, it's the Tax Lady, and it's time to talk taxes, and we want to hear what you have to say. I know that the state of New York and federal government is busy sending out letters, and if you've gotten letters or you know somebody's gotten letters and you want to share your experiences or call us and ask for some direction, we're very happy to help you. I'm Esther Goulias, the Tax Lady from EG Tax. I'm joined in studio with Tiffany Fabian.
Hey there, Esther.
And Christopher Fabian.
Hello, Esther.
And here it is on a rainy Saturday. You know, you just live for Saturday, don't you?
Yep.
Especially in July.
You live for Saturday.
Yep, absolutely. And then you want to cut the
I feel
lawn,
bad
do
for-
yard
I
work.
feel bad for the weather guy, because he'll say it's going to rain, but not really for very long. I think it's going to have some sunny periods,
because he wants to let you know you can fit in your barbecue and your picnic.
One of my clients is a weather person for one of the stations here, and when he comes in, especially during tax season, I give him a very hard time because by then it's usually mounds of snow and Arctic stuff.
Yeah.
But anyway, we're going to talk taxes. 8030930, 8030930, star 930 and a cell phone. And our topic for today is it's like this is half the year's over, and if you wait till January to do stuff, it's too late. So we try to kick that can. We don't want you to kick the can down the road. We're trying to get you to do some stuff that helps you financially and helps your tax situation. I know one of the things that we've really had some really great responses with our EG Tax Business Solution.
Yep, absolutely. And I think a lot of it is due to the person who heads it up, Maria Rickard at our office. It's like she just loves it. She does a great job. Business Solutions is taking a look at your business, and we do bookkeeping and payroll and planning, and it's really important. I remember when I started 13 years ago, Esther always taught me money in, money out, and so
hopefully you have more money in than money out.
That's right. And so Maria does your books, and she does it so well. And then we take a look at your business situation. Should you be an S Corp? Should you be a C Corp? Should you be an LLC? So, you take a look at everything, and it's getting you organized, and it feels so good to be organized.
Right. Well, and you want to make sure that you're not doing anything that ultimately would be a problem later. Like, for instance, that you have to make sure that you have your workers' comp in place and your disability insurance. And so we partner with everybody because it's true we know taxes, but we also run business.
Right.
And we help businesses. And so I think that's what some of the really great things that we do
because
when you partner with us.
Also, Maria does payroll, and there's all the payroll taxes, and you want to make sure you're allocating the money for the state and for the federal. And
that you're paying your payroll taxes, because nothing can close down your business faster than when you're robbing Peter to pay Paul.
That's right.
So
she does a great
Tax
job.
Business Solutions, you can call us at our corporate office at 632-7886 or visit us online at egtax.com, and we will help you straighten out your mess.
Yeah, and I wanted to say that Maria will even go into your business and take a look and see if the person who's currently doing your books is doing everything right. She went and looked at a person's business that we all know, and she says your bookkeeper is doing a great job. She just needs some more tools. Right.
And so that's another thing that we'll do is we'll come in and because I'm not so interested in charging somebody a lot of money.
Right.
I really want to make somebody successful. I want them to have money at the end of the year.
Yep.
And so if you don't need the help, we're ethical, and we'll tell you you're doing good.
That's
and we're kind of a safety net for you. So, and then the other thing is we have tax school coming up, right?
Yep, we do.
We got tax school starting in October, but it's not too early to call us. We'll give you more information. It's a great winter job, when it's cold out, as you already said, and the snow piling up. If you're not a skier or a snowmobiler, don't like the winter, what a great thing to do, just to work inside, stay inside, and you learn and you help a lot of people.
A lot of times people say to me, and I really love to do accounting work. Really, the real love is law.
Right.
Because really what you are doing is we're interpreting laws and we're administrating laws, and you have to love people.
That's
and
right.
That really, because if you're really the kind of green eye shade kind of person, you like compiling numbers, that's okay, but our real thing is how to interpret the law to save people the most money, and you want to make sure that you care about them and their situation. So if you don't really like people, we like you, but we really don't want you to work.
And then Chris was saying, it's a great job, great occupation, and also nowadays with Obamacare, you probably have to file a tax return. So it's another twist, and taxes are very exciting. It really is, and it's I can't tell you the reward when you help somebody, like you were saying, Esther.
It's remarkable.
Yeah.
It's just remarkable. I can remember one time back a long time ago, a client of mine was using a CPA, which is wonderful. I'm glad that but many times CPAs don't sit down and talk to you. So it's kind of like you drop off the stuff. That's what they do the tax return
Right.
for. And the client called me, and I was working professionally in another, doing TV with this person. And she called and she says, we owe $42,000, and I hate to bother my CPA with this. Do you think you could look at this and see if maybe? So I sat down with she and her husband, and they kept saying, he gave me the same list that he gave the CPA. And I said, let me ask you other questions.
Mm-hmm.
Do you advertise? And he says, I'm extremely well. I know you're, but do you ever advertise? And he says, well, I do put ads in the Wall Street Journal. In the Wall Street Journal? How much can, anyway, when we got all done, the CPA didn't sit down and talk with them, and so they ended up getting a $5,000 refund instead of owing $42,000.
Hello.
So I mean, those are the kind of things that because we love our clients, and we want to make sure they don't overpay. We want to make sure you pay what you're supposed to,
Right.
but we don't want you to overpay.
Right.
So and Chris, you're going out of town this week. Where are you going?
Going out of town, going to New Orleans.
What y'all going to do down there?
Well, wish it was a vacation, but it's not. Going to a IRS trade show, and we're gonna, try to sell some franchises.
And our tax book, you're
in our
bringing
tax
that.
book, but the franchise. If somebody out there, you love taxes, just been doing it a little on your side, but you think you want to get a go, get our name behind you. We have great openings, fire sale, if you want to call it that. Available areas still around here, just on the outskirts, but Rochester area, Jamestown,
right?
you know,
that kind of stuff. We're selling those franchises. So, so you're going to be down there selling franchises in New Orleans
in New Orleans
and eating crawfish
and gumbo. Not really, not me, but
have you looked to see what the weather's going to be like?
no,
It's going to be hot.
I know.
It's
I'm
always
so
hot.
jealous.
It's going to be hot.
I know you're going to be in a building, but yeah.
Last time I was in New Orleans, I was at an IRS trade show, and it was so hot outside. You know how it is in the winter in Buffalo?
Ugh.
The windows get all frosted up?
Yes.
Well, the windows were like reverse frosted
Oh.
because the air conditioning was so cold inside, and it was so hot and humid outside, it was all fogged up.
Anyway. He's Googling it on his phone right now to see what the weather's
I'm
going to be
Esther
like.
Golias, the tax lady from EG Tax, 8030930, 8030930. We're going to talk about your tax situations, your planning situations. We're going to talk about how much you can contribute to your pensions and how to save the most money on your taxes. We're going to take a short break. We'll see you on the other side. that, young people? Who's it? Who is it?
I
Who
know
is
the
it?
song. I'm really
So do
bad
I.
at this.
Come on, you all know
Oh,
it.
you guys. Is that the Beatles?
No.
No. Who is it?
No,
Aerosmith.
that's it.
Aerosmith.
I was
That's
going
it.
to say it's a hair band.
Yeah. All right, anyway. I'm Esther Goliath, the tax lady from EG Tax, 8030930, star 930 on a cell phone. We're talking about, it's the middle of the year, and I'm going to tell you, if you haven't gotten your refund yet, which many people haven't, because the IRS is kind of doing pre-audits, and you need help with that, give us a call Monday through Friday, 632-7886. All right, but here we are, middle of the year, planning for your pension. It's a great way to reduce your tax liability. If you have a 401k plan at work, do you have to put a percentage in of your salary?
No, you don't.
You
Right?
used to.
You used to. But now it's an elective deferral, and you can put in on a 401k up to
Of $17,500 a year
of your salary.
of your salary, unless you're over the age of 50, and then there's a catch-up provision, and you can put 5,500 extra in.
So if you're somebody that's putting in 5% of your salary and you're thinking that's what it's capped at, that's not true.
Right.
It's an elective deferral, and you can do a
17.5
17.5 with an additional 5,500 if you're age 50 or older. So that's something that, and maybe you can't do it all at once, but adding more to it is a really good thing.
Right. And I think so many people still think, Chris, correct me if I'm wrong, that it's still capped at that 5% or 6%, right?
Well, they get confused with the employer matching, how
Right.
much that percentage is to what they can get put in, and it was up to 15% before. I mean, look at the people with the selling your home. They still think of the old law,
Right.
and that
Capital
changed
gains.
over 16 years
Right.
ago. So, remembering the old law, people still have that.
Okay, now if you're somebody that knows there's a pension plan at work, 401k or whatever plan they might have, Simple, SEP, whatever, how do you fund it?
Out of your paycheck. It's a elective deferral out of your paycheck.
So you have to go to HR, sign up for it, and it's usually done out of your paycheck.
That's
correct?
right. That's right. And so if you're starting a brand new job, a lot of companies have a waiting provision before you're allowed to do this elective deferral for your pension.
But
so
some of them don't.
right.
Some of them don't. And so, go down to your HR department. And what does it do for your income taxes?
Oh, it's a good thing. Less money is taxable. Less money to show on line 7, which means the answer is going to be better at the end. So it's a really, really good thing.
So if you're in the 25% federal, 6% New York State, that's 31%. So if you put away $10,000, you save $3,100,
That's
right?
not bad. Right.
So that's $3,100 that you get to spend.
And not to mention on the federal, if you're a lower income person and you're contributing to your pension, there's a pension savers credit. And then if you put money into an IRA, there's an adjustment to income for IRAs. So
But it also, though, what you mentioned reduces your income, which also could help you obtain bigger credits, the education
That's
credit.
right. Especially, it's a great plan for people that are getting close to that phase out to lose those credits. If you maximize your 401k plan at work, it reduces your overall adjusted gross income, which increases your credits. And especially if you're getting phased out, that's really important. And that's what this time of year is so important for.
Sounds like tax planning.
You want to make sure that you're not going to shoot yourself in the foot, right?
I mean, I had someone the other day, he needed $50,000 to buy a house or something. And he's like, how do I take it out? What do I do? I have these stocks. I said, well, take it out of your stocks, but put the money in your 401k to bring your income down to keep your taxes in, because right now he was paying 0% on his capital gains and
And
his
that's
dividends.
what you wanted to make sure he did, right?
Yeah. I said keep that income down because then you stay at that 0% rate, because otherwise that $10,000 between capital gains and dividends, you're paying an extra $1,500 to the federal and an extra whatever.
and
to
you
New
know
York
what?
State.
All that was a phone call, and I'm so glad that he picked up the phone and
That's
called you.
exactly right.
Yeah.
Well, we're going to go, speaking of phone calls, we're going to go to John in Tonawanda. Hey, John, how can we help you?
Question.
Yeah.
I closed out 401 I had, and I don't know, it was 50-some thousand. I had to pay. I didn't want to pay the car loan, and I had a wedding I had to pay for. But anyway, they held the federal, so I held out about 30% of the 50-some thousand. then I wanted to hold something for state, but they said they don't. And I know with the federal, the one time I did this, I got fined because I didn't take any tax out. You have to have so much in a quarter. And my question is, do I need to take something out for the state?
Estimated
All right.
payments.
So here's the thing. When did you take this money out, John?
I took it out a couple weeks ago.
All right. So you have 60 days that you can take that money out and you can roll it back in to an IRA and it won't be subject to penalty. And I'm going to tell you.
I spent it all.
Okay, but let's talk about, do you own a home?
Yes.
Do you have equity in your house?
I have a home equity.
All right. Do you have equity in your house, though?
Yes.
All right. So that 50, do you have 50,000 in equity in your house?
Yes.
All right. So if you borrowed the money on a home equity credit line, you would pay 3%. All right. So that'd be $1,500. Right now, with the state and federal, you're going to pay about $20,000 on that $50,000. So if you went and borrowed $50,000 on your home equity credit line, and you paid back your 401k plan or rolled it into an IRA, okay, you will pay $1,500 this year in interest, but you'll still have your $50,000 in your pension plan, and instead of paying $20,000 in income taxes this year, you're going to save yourself $18,500. In other words, John, the best.
Not to interrupt you, but I see the math. But somewhere down the line, I'm going to have to pay that.
Okay, but first of all, how old are you?
66.
All right, so that's true. All right, so it's going to make your Social Security more. Are you working right now, John?
No.
All right, so it's going to make your Social Security 85% taxable. So,
which has always been. I get it.
all right, so you have a pension plan.
I have a pension plan.
Okay. All right. If I thought maybe you were under the age of 59 and a half. In your situation, then all you're going to do is pay the state of New York. Now, how much is your pension plan? Is your regular pension plan?
My regular pension plan brings me up to the $20,000 that they allow for deduction.
And
All
are
right.
you married or single?
Married.
Yeah. So.
And my
Okay.
wife gets about $20,000 pension also. So.
Okay,
Yeah,
so
you
in
should do
your
an estimated
situation,
payment.
it really would be better to do the loan, but you are correct. Over the age of 59 and a half, you're not going to have to pay the penalty. So at least that's the 10% that you won't be penalized for. But I will tell you, I think that you would be better to take less out in a year so that they don't, you don't lose your exclusion on the state of New York as well. But it isn't as bad as if you were 59 and a half.
Well,
So the question is on
I'm
New
at
York
that
State,
level
though.
Anyway, Esther, anytime I take money out, because we're getting $20,000, and then the Social Security, there's no tax in the state.
Right.
But my
right.
original question was,
should you right? All right. Well, here's the thing: if last year's liability was, let's say $5,000, as long as you have $5,000 in withholding equal to last year's liability, there's a 2210 that you can fill out that you can owe more money than the $1,000 and they won't penalize you. And the same goes on to New York State. So if last year you owed New York State zero taxes because your Social Security is tax-free and the pensions are tax-free on New York State, you can actually owe money this year. You can do an exclusion to penalty and you won't have to pay any penalty. So no, you don't have to pay anything into New York State.
But you might owe this year.
You will probably.
You will owe this
but
year.
But there's you can avoid the penalty.
Okay, but I mean, I know I'm going to have to pay tax. I mean, eventually, everybody takes money out is going to have to pay taxes unless something down the line changes. Do you agree with that statement?
Right, absolutely. The difference is, John, I thought you were under the age of 59 and a half. Number one.
No, 66.
Yeah,
got
no,
that.
you're good to go.
And
in
then
that
Esther raises a really good point. There's a way to waive and get rid of the penalty for not withholding enough to New York State, and that's if the prior year your tax liability, you were under what you will be for this year, so you're going to be okay.
So you probably, if you want, John, you can call us on Monday, and we'll work out all the figures for you. But it sounds like on New York State you had no liability last year, right?
Well, no, we got a refund. I mean, we probably got $6,000 or $7,000 back
On New York State?
Yeah. Yeah.
Are they withholding a lot on your pension?
Well, my wife worked last year.
Okay, but
and
this year?
she retired. This year, no. Well, this year we both have Social Security and our pension.
All right,
We
so
both have state tax coming out of our
okay,
pension.
so then since she worked last year, you have to withhold.
You may wanna do an estimated
right, an
payment.
estimate, because your income is probably a lot more in 2013 than it will be in 2014, which would mean you had a liability last year, so there would be no exception to penalty.
I'm working at the office on Monday. Just give me a call, John, and over the phone I could
and
probably
we'll
work
figure
it
out how much you should pay
What
in.
number is that?
632-7886, and there's no charge.
6327.
886.
Okay. Well, I appreciate the advice.
All right,
Thank you very
thanks,
much.
John.
Thanks.
Bye-bye.
Bye-bye.
Yeah, and that's the whole thing is if he were under the age of 59 and a half, it would have been a whole different scenario.
Right.
Also, if he didn't have his pension plan, his Social Security would have been 85% taxable. But in John's case, his Social Security already was 85% taxable.
Right.
So, so is less money being taken out better? Yes, most of the time, but in his situation, it's almost 6 of one, half dozen of
Right,
the other.
right.
And that's why it's best to always call, because we can help you chew up the numbers to make sure that you aren't shooting
Yeah.
yourself in the foot. So many times when somebody's retired and they're on Social Security, they don't even think about their Social Security being 85% taxable. Here they are making $30,000 in Social Security, and they don't even think about $24,000 being taxable because just a little move like what he's doing.
Oh, yeah. I can't tell you, and at tax time, what a bitter pill to swallow when you find out, I owe $1,500, and that's because your Social Security became taxable. And I have that conversation a lot of times with
That's
taxpayers.
exactly right. And that's what we're there for. We want to be your advocate. You can call us. There's no charge. We want to make sure that April the 15th isn't a surprise to you. I'm Esther Gulius, the tax lady. 8030930, 8030930, star 930 on a cell phone. And I know I got Larry from Georgia hanging on the phone.
No, do Georgia, how you say it.
Georgia. But we're gonna talk to Larry on the other side of the news. We're gonna break for a short news break, and we'll see you on the other side. this is either, but this is Esther Golias, the tax lady. And our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. And Larry has been waiting for so long. Hey, Larry, how y'all doing?
I'm doing great. After all I can say is the encyclopedic knowledge of you and your crew is honestly it's like a beacon of wisdom helping millions of people around the world. You guys are wonderful.
Thanks, Larry. How's the weather down in Georgia?
Well, yeah, it's doing fine. It's just raining a little bit, but that's fine. Esther, I've got two fast questions. I know you're busy. One, basically, does every dollar you contribute to assuming you itemize your deductions, does every dollar you contribute to a 501c3, you eliminate $1 tax liability? And then my other question is, Esther, if I use a home equity loan to purchase a house, second house down the road, and if the home equity loan, if I take out, say, $150,000, because of the ceiling, will I be barred in any way for using $100,000 of that to purchase the new home?
Okay,
Do I
so
make sense?
let me do the first thing for the
The
last thing
501s.
first.
Oh.
All right, so the maximum you can use as a tax deductible itemized deduction, non-business, okay, is you're limited to $100,000 on a home equity. So you don't want to take $150,000 on a home equity. You'd end up with $50,000 of it not being deductible. So you could do a $50,000 first mortgage and a $100,000 second mortgage if you want. But if you're going to pay the money on the cost of placing a mortgage, you may as well just do the whole $150,000.
Okay.
All right, that's number one. Number two, the 501c3 is deductible, and you'll get a deduction for each dollar you give, but that's multiplied by your tax bracket. So if you gave $10,000 to a 501c3, to a charity, a church, Red Cross, Salvation Army, you get to take the whole $10,000, and it reduces your taxable income by the whole $10,000. But that's multiplied by your tax bracket. So if you're in the 10% tax bracket, you're only going to save $1,000 in taxes.
I got you. Okay, so right now I'm in the 25% tax bracket. So whatever the math is, right, is how much I'd be able to deduct for those donations.
So you're going to, if you do $10,000 in donations at 25%, you save $2,500.
Got it.
Okay?
Thank you so much.
Thanks, Larry. Have a great week.
You too. Bye-bye.
Bye-bye.
Were you going to say something?
Oh, it's just because, that's when people, especially with cars, I'm going to donate my car. It's going to save me a ton of money on my tax return. And not really, because it's, first of all, like you just explained, it's the percentage of tax bracket you're in. But then it's also not the blue book value what it's worth. It's what either the company uses it and they get it appraised, or what they sell it for in auction. So you might think it's worth $5,000. But if they sell it for $300 in auction, that's all you get for
That's
charity.
all you get. Right, but and a lot of times people think that like what Larry was thinking, that you get $1 per dollar write-off, which is true, but that's multiplied by your tax bracket. The same is true on your income. All your income is multiplied by the tax bracket too. You're in the 10% bracket. You got an extra $10,000 in income. It costs you $1,000. So when people say, "I'm not going to work overtime, it's all going to the federal government," it's not. It's not. Now, they may be withholding at a larger rate, but you'll get back the difference at tax time.
Yeah, I explained that so many times. Yeah.
Right. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. All right, we're talking about stuff for your pension. We were talking with John called before about the early withdrawal penalty.
Right.
You want to make sure that if you're going to take money out of your 401k, your IRAs, your pension plans, that you do it after the age of 59 and a half to avoid the 10% penalty.
Right.
Now, there's exceptions to those penalties,
Yeah,
right?
I was going to.
So some of those exceptions would be
If you are over the age of 55 and you're separated from your employer, or if you're over the age of 50 and you're a public, you work for a police agency, right? A public service agency over the age of 50.
but that's all. I mean,
those
you
are
got to work for a public
safety service. If you're over the age of 50.
Totally and permanently disabled. There's
Using
an
it for
exception
college.
For that.
Death, buying your first home.
Right, but
If
that's
it's
from
an
an IRA.
Right.
Yep. Yep, and it's the same thing with school,
and
IRA.
IRA for your first $10,000 for your first time home buyer. For college, you can take it out for your IRA.
Medical.
Then there's also
Over
if you're
7.5.
paying a liability to the federal government from a levy or a lien, then there's no penalty then.
Right.
So those are the exceptions to penalty. So you don't want to get into that situation where they're gonna penalize you. Also, watch the costs on your 401k plan. When they're sending you these quarterly reports, you're going to find out that there are costs in the administration of your 401k. Talk to your employer. Perhaps there's a less expensive fund to go into, because on the left-hand side you can be making money. On the right-hand side they can be costing you a lot of expenses. And then what happens when you change jobs?
You have 60 days to roll it over to another qualified plan. And so they'll usually send you a notification. You've got this plan at this other place, and make sure that you roll it over within 60 days. And you want to roll it over to a qualified plan, or else you'll get taxed on it and you'll get hit with the 10% penalty.
If you're under
Right,
the 59
right.
and a half, right? Now, the other thing is, when do people have to start doing RMDs?
When they're 70 and a half.
Right.
That's
So-
if you're now from your IRAs, yes. If you're still working in that company, you can still contribute and not take out your
That's right.
RMD yet.
So here I am, let's say 73, working at a company. They still have a 401k. I can still contribute, and I don't have to
take out
the RMD.
Correct.
Right. That's
All
right.
And if anybody is wondering, during the week, we're there. We want to help you. So give us a call. We'll work all the way through your situation so that, we'll help you, steer you in the right direction.
And then there's always to Roth or not to Roth.
Right.
I mean, and you have to look at the whole picture. The concept sounds really good. Tax-free money later on. But sometimes, like, if you look at, you may be in the 25% bracket right now, and when you retire, you're only going to be in the 15% bracket.
Or maybe in the 0% bracket.
So if I'm going to get it all tax-free, you're going to pay 25% now to save 10, 0,
right.
15%.
So let's just say that you're a highly compensated person right now. Let's say you're making $200,000, all right? So you think to yourself, and the only pension plan you have is the one you put into. And let's say you're 55 and you got this great job, and so you only have like 5 years before you retire. When you retire, there isn't enough money that you're going to have besides your Social Security and the small money you say that'll even put you in over the 10% tax bracket. So you really have to look at what you're going to get when you retire. Now,
Right.
Let's say you're a teacher. You're going to get $75,000. Your spouse is a teacher. They're going to get $75,000. That's $150,000.
That's a horse of a different color.
Maybe you're the kind of person that needs a Roth.
That's right.
Right?
That's right.
A Roth in your IRA or a Roth in your 401k or your 403b.
And that's really hard for people to get their head wrapped around when Esther said, now you're in the 25%, but when you retire, you might be in the 15%.
Or
and
less.
when I have these conversations, it's really hard for them to see the big picture.
Well, and that's
sometimes.
where you have to project and
Right.
take a look at everything. I'm Esther Galius, the tax lady, 8030930, 8030930, star 930 on a cell phone, and we got Daryl in Newfane. Hey, Daryl, how's things up in Newfane?
Oh, they're doing great. It's a little bit rainy, but not too bad.
That's great.
First off, I would like to say it's a privilege and an honor to be able to talk to you today.
Ditto back to you, sir.
Thank you so much. My question was, I've been going to these tax people for a long time, almost 15 years, 14, and there was a mistake made on my taxes from my preparer.
Okay.
And then all of a sudden I find out that I'm having to owe money that, isn't quite in the budget. I was wondering, is there any advice you could give me?
All right. Well, first of all, how do you know you really owe the money? They just sent you a bill?
The IRS sent me a bill. Yes.
Okay. Now, did you take it into your accountant to have them look at it?
Yes, I did.
And they concurred?
I sent it to the preparer, and first they said, because it was Social Security, my wife, and first they said, well, this wasn't in the folder when you had your taxes done.
Mm-hmm.
And I said, it was, because the gentleman said that because he uses silver staples and that it was used with different staples, meaning that it wasn't in there, but I actually took it out and faxed it to him. Mm-hmm. So that's why the staples were different.
All right.
It was kind of like he was to say it was my fault at first.
All right. So let me ask you this. Well, first of all, the good news is on New York State, it's going to be tax-free on New York State. Secondly, I know that if it's an error that we made, we would pay the penalty and interest. So you ought to approach your preparer and ask if they'll pay the penalty and interest. The third thing is you can set up a payment program so that you can pay it over a period of time, so that it'll help to relieve the anxiety, so to speak. And if you need to set up a payment program, you can stop down at our office, or we can do a three-way call and set up a payment program with the IRS for you.
And then for what it's worth, Daryl, we follow the same logic that all other tax firms or tax preparers do, the interest and penalty. That's just what all of our competitors do. They do the same thing.
Yeah.
And it's horrible, that happens. And Esther's right. A payment plan is a really good way to go, and we would certainly help you.
Right. So if you need any help with that, Daryl, just call us on Monday. We'll help you set up a payment program, and then I would suggest you talk to your tax people and see if they won't reimburse you for the penalty and interest. Okay.
Okay.
Thank you, Daryl.
The other question.
Yes, sir.
Was oh, geez, it just left me.
Oh, shoot. Well, thanks for calling. Call us on Monday. We'll help you.
All righty. Thank you very
sir.
much.
Bye-bye. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we're going to take a short break. We'll see you on the other side.
I've just seen her face, I can't forget the time or place where we just met. She's just the girl for me, and I want all the world to see we've met.
Sing it.
Had it been another day, I might have looked the other
Well, that
way,
is
and
good.
I
All right, so who's that?
Come on, I got to give you one you know each week.
I don't.
Oh, you got to know. He says you know it.
You do know it.
You do know it.
I don't know. I really don't know. Who?
Paul,
Stevie.
George.
Oh, the Ringo and
Ringo.
and the Beatles.
Mhm,
Oh,
indeed.
jeez. I know
Good
the songs.
job.
I just don't know who the singers are.
I can't fault you for that.
Yeah, well, what can you do? I'm Esther, but I know taxes. I'm Esther Golias, the tax lady. 8030930 star 930 on the cell phone, and we got Roger from Hamburg. Hey, Raj, how you doing?
Hi there.
Are you better at these songs than I am?
Roger that.
I'll tell you, I'm not a disc jockey, but I do love taxes. So how can I help you, Raj?
Well, my wife is a beneficiary of an annuity which
Okay.
her mother invested before her death.
Okay.
We had 5 years after her death to take the money out of the annuity. The money that it earned in the meantime was being earned tax-free, but when we take it out, we have to pay taxes on it, on the amount that it earned.
It was being deferred, but yeah, okay.
Yes.
Okay.
Yes. So my question is there any way or any investment, like can we roll that annuity over or do anything with it to avoid paying the taxes on
Well,
it?
are you still working?
I am self-employed, yes.
Okay. Well, what about your wife?
She does not work.
Okay. How about opening up an IRA for her? So you take it out of the annuity and you put it in an IRA for her or for you, or depending on your profit, you could do a SCP where you can put in 20%.
So I just want to make sure, because what Chris is saying is you can't roll over that money,
Right.
but you can roll over fresh money. In other words, how much are we talking about taxable, Raj?
About $100,000.
Taxable?
That's the growth?
That's
That is the amount that the annuity has earned over its.
all right. So you got $100,000 you want to shelter. Now, what's your net profit on your business, approximately?
60,000 maybe
All right.
a year.
So do you have a SEP or a simple setup for your company?
I do not.
All right. So
we do have an IRA.
all right. So you can put you can do a match on your SEP at work, and you can put so that would be about 24,000 you could put into there, and you could do an IRA for your wife. And so what Chris is suggesting is that looking at that $100,000 annuity, that's money, and you just need money to fund your other pensions, and so you could fund about almost 30,000 of that 100,000.
And then, Esther, correct me if I'm wrong, but Roger, was your mother-in-law over the age of 59 and a half when she passed?
Yes.
So don't forget you get to exclude up to $20,000 on New York State if you're the only beneficiary. So don't forget to exclude the New York State
Right.
$20,000 because she was over the age of 59 and a half.
Right. So we can't get rid of all of it, but you can certainly get rid of a lot of it.
Okay, so it's not a direct rollover or transfer.
Nope.
I mean, we
nope.
do have
In other
to
words,
take it out.
so you're kind of hopscotching around.
Yeah.
Just in other words, you're going to be able to deduct it on the left-hand side. On the right-hand side, you got the money. On the left-hand side, what we're trying to do is dig up some new deductions that you can create. So using your SEP at work or
IRA.
you're the only owner.
Sole proprietor.
All right, so actually he could do a solo IRA
Yeah.
for 401k, so he actually could put $42,000 away in a solo. So you could put $42,000 away in a solo IRA, and your wife can do an IRA, and that gets rid of half of it. So that's pretty cool.
And don't forget to back off $20,000 on New York State.
Right. Okay?
All righty.
And if you want help, give us a call
Right.
during the week.
So it's a solo IRA. All right, but remember, Rod, you're putting it away in a pension plan, and so you can't take that out until you're 59 and a half without penalty, okay?
That's okay. Yeah.
And at some point in time, you're going to pay taxes on it.
Of course.
All right? All right.
Okay.
Thanks, Raj.
Well, I know
Thank
your
you very much.
Have a
favorite
good
motto,
day.
Esther, is defer, defer, defer,
Die. Right. Dying is the way out. and then you get stepped up basis, and all your heirs are happy, and
Somebody said we're in
and
a
you're
death
at
trap.
peace. All right, so some things want to talk about here are IRS red flags for audit, making too much money.
Oh, then you're going to be on that radar quite possibly.
Because 27% more people are audited that make a lot of money.
Right.
Failing to report all of your taxable income.
Right. Chris was talking to a client the other day, and didn't you say somebody forgot part of their Social Security or part of their pension? Yeah. So you got to report all your money.
I mean, all the letters you get are audits.
That's exactly right. Except that they don't feel like an audit, but they're really an audit because they not only tell you we don't agree with you, we're sending you a bill.
Yep.
So those are audits. Number 3, taking large charitable deductions.
Right. That's that they're going to say year after year, wait a minute here. And
Have the proof, have the canceled
Right.
check.
Now,
have
that
the
doesn't
letter.
mean that doesn't mean you shouldn't take the deduction.
That's
It just means that you're more prone to audit if you are a generous person. So like Chris is saying, make sure you save your deduction.
So
You have
Warren
your proof.
Buffett, who gave $2 billion
he's
away,
trying.
he should save that receipt.
Probably. But he's probably got photo ops and big checks.
Yeah.
All right, and then day trading, losses on a Schedule C. So
Yeah.
if you're somebody that's a day trader and that's your business and you're taking losses as self-employment income because you're a day trader, that you're somebody
I think you have a few clients who do that, right?
I have day traders, but,
Yeah.
Not
but
someone who
not that
that's their
was
sole-
self-employed.
Right. Okay.
Right.
Gotcha.
Claiming rental losses.
Right. I've I have a few clients that have big rental losses year after year, and it's really hard to have that conversation. But you got to have that conversation that you're saying, "Hello, look at me," and so
that's the important thing. Are you renting the property at fair rental value? If you're giving it to Aunt Hilda at a deal, then that's not a business, and you can't take those losses. The losses are limited by your expenses up to including depreciation. So you have to be very careful about that because then you're opening up yourself for audit. But it doesn't mean that I don't think you should take them.
right.
But I'm just saying you want to be prepared.
Yep.
Bookkeeping is very important. All right, deducting business meals, travel, and entertainment.
Chris, you're going out of town soon, and so you are going to want to keep track of all those business expenses.
You're darn right, because I'm going to end up paying them.
But no, I mean, I've been on audits for people before with this, and I tell all my clients, keep a notebook, a spiral notebook. You tape the receipt on one side of the page, and on the other side of the page, you write, took Bob Smith out to dinner to discuss new windows at his house, blah, blah, blah. You know,
Doesn't
you
have
have
to be
who, what,
fancy.
where, when, and how, and the auditor can't question it.
Right. Well, they can
And-
question.
well, they can, but they look at it and they say, okay, you're right.
That's right. And as a matter of fact, if it's really a contemporaneous log, it probably is pretty nasty looking because you're saving all your little pieces
I mean,
of paper.
I know just a couple weeks ago, I was at an appeals, which is one step further from an audit, and the guy was a realtor, and the auditor disallowed the mileage. We walked into appeals, and the first thing the appeals officer said, well, under Cohan law, I'm giving you 80% of your miles because you're a realtor and I know you drove.
Right.
Yeah.
So right away, they know based upon your occupation what you
And
do.
by the way, if you are somebody that's gotten audited, EG Tax will help you. We don't charge anything to help you at an audit. So if you're somebody that's kind of you got this you brought in all your proof and they disallowed it, sometimes you have to go to the next level. And when you go to the next level, you're dealing with a whole different
slew of people.
Right, and so that's your right as a taxpayer. Well, I'm going to go quickly to the phones and talk to Dominic in East Amherst. Hi, Dom. How can we help you?
Hi, Esther. Thanks for taking my call.
Yeah, what you got?
Yes, on a house that's deeded over in a life estate.
Yep.
How do you determine the tax liability for that when you sell it?
All right. If the title and deed was transferred over to the heirs prior to when the life estate was done, then in essence, the basis of the home goes back to the original basis of the person who bought it or built it, plus all the improvements that they had, plus any stepped-up basis because of the spouse that might have predeceased them giving the house, and that's what the basis becomes to the heirs of the life estate. If, however, the deed and title wasn't transferred and the person retained ownership, then you would go to the fair market value on the date of their death. But if it was actually transferred over with the deed and title, then it goes back to the original basis.
Okay, so that would be when they bought the house.
Plus all their improvements, and if the other spouse had predeceased them before they gave the life estate, there's a 50% stepped up basis there. But so it's like a yin yang. You're giving away the asset so that you don't have a nursing home claim against it, and so that's good. But at the end of their life, when they finally do sell it because it was a life estate, the heirs pay the taxes. So
Right.
All right.
Okay, thank you very much.
Thanks, Tom. I'm Esther Golias, the tax lady. If you need help during the week, 632-7886 is our phone number. We're at egtax.com. We want to help. Don't pay the bill until you call us. I'm Esther Golias. Have a great week. Bye-bye.
Bye-bye.